everyone! Today we are exploring two technologies that could transform the way society uses money and owns assets: stablecoins and tokenization. Unlike Bitcoin, whose price can change dramatically, stablecoins are designed to maintain a stable value. Tokenization goes even further. It can turn money, bonds, company shares, or other assets into digital tokens. But why could this be useful in everyday life? A stablecoin is a digital token whose value is linked to a reference asset, usually a traditional currency. For example, a euro stablecoin aims to remain worth approximately €1, while a dollar stablecoin aims to remain worth $1. In many cases, the issuer holds reserves, such as cash or short-term government bonds, to support the value of the tokens. However, stablecoins are not automatically as safe as money in a bank account. Their reliability depends on the quality of their reserves, the regulation, and the ability to exchange them back into traditional money. First, stablecoins can make international payments faster and potentially cheaper. Imagine a small company paying a supplier on another continent. A traditional international transfer may involve several banks, exchange fees, and limited opening hours. A blockchain-based stablecoin can circulate 24 hours a day, 7 days a week, without waiting for banks in different countries to open. Stablecoins can also help freelancers, online creators, and international businesses to receive digital payments more quickly. Another advantage is programmability. A smart contract could automatically release a payment where delivery is confirmed. This could reduce delays, paperwork, and the need for several intermediaries. However, stablecoins also create risks involving reserve quality, cybersecurity, money laundering, financial stability, and dependence on foreign currencies. Tokenization means creating a digital representation of an asset on a programmable ledger. For example, a bond, an investment fund, or a company share could be represented by digital tokens. Each token contains information about ownership and may also include rules defining how it can be transferred. The original asset does not physically enter the blockchain. The token represents a legal or financial claim linked to that asset. Tokenization is already being explored for government bonds, investment funds, bank deposits, and other financial instruments. Nevertheless, it still represents only a small part of global financial markets. Tokenization could make certain assets easier to divide and exchange. For example, instead of buying an entire expensive asset, investors could potentially purchase smaller digital fractions of it. This could lower some financial barriers, although regulation and investor protection would still be essential. It could also improve financial markets. Today, buying an asset and transferring the money often happen through different systems. This creates delays, reconciliation work, and counterparty risk. With tokenization, the asset and the payment could be exchanged on connected digital infrastructures. Stablecoins could act as the digital payment sides of that transaction. Smart contracts could also automate interest payments, ownership transfers, or compliance checks. Technically, this system combines distributed computing, cryptography, and programmable software. The blockchain is maintained by many computers that use a consensus mechanism to agree on the state of the network. Cryptographic signatures prove that a transaction was authorized by the correct owner. Hash functions protect the integrity of the recorded information. Smart contracts then apply programmed rules. For example, a contract could transfer a tokenized bond only if the buyer has been verified. The most interesting concept is called atomic settlement. It means that the asset and the payment are transferred together. Either both transfers happened or neither happened. This can reduce the risk that one participant sends money but does not receive the asset. Stablecoins could make digital payments faster and programmable, while tokenization could change how society owns and exchanges assets. But technology alone is not enough. These systems also need strong regulation, reliable reserves, cybersecurity, and clear legal ownership. Thanks for listening, and remember, the future of money may not only be digital, it may also be programmable.